We are picking up our lesson on variances. And so when we discover that we have a price variance, we're going to want to go back and figure out what caused that. And we're going to report that back to the person who's in control of that area. So it could be purchasing, it could be, so whoever's responsible for that, we need to not just tell them, but we need to figure out what happened there and try and figure out how not to have it happen in the future. It's important to note that not every variance is the result of somebody's fault. So it could be that there was, just some odd environmental factor or economic factor that resulted in a spike in prices or a disruption in the supply chain, and then we had to source material from someplace else in order to meet customer orders, and that material is more expensive. So there are all kinds of things that happen, and so we shouldn't automatically assume that if we have an unfavorable variance that somebody isn't doing their job. When it comes to direct labor variances, it's basically the identical analysis that we gave when we were looking at costs. We're going to subtract out the actual rate per hour minus the standard rate and then multiply that times the actual hours. Now, note that this varies a little bit from what we did because we multiplied here times the standard price when we were looking at materials. When we are looking at labor, we're going to multiply it times the actual, not the standard hours that we had anticipated. And so again, an unfavorable variance means increasing costs, and that would be a debit. Favorable is decreasing costs because we did better, and that would be viewed as a credit. If we are looking not just at labor rate but at time, this is where we go back to multiplying by the standard rate per hour. So we've got actual direct labor hours minus standard direct labor hours minus standard rate per hour, and that gets us our direct labor time variance. And it's a bit repetitious, but you can, I assume, figure out the favorable and unfavorable at this point, so I won't repeat that. Now, obviously, we're going to, if we've got an unfavorable variance, go back to the source, try and figure out is somebody not paying attention to which employees have worked more than their 40 hours and are now making time and a half, for example, or was that really a necessary thing? Did we need to do that in order to meet a time commitment? So we don't want to assume that a variance is automatically the result of somebody not either predicting accurately or controlling costs. There may be other factors that went into that, but if you, on the other hand, are the manager and you notice that there's variances that are occurring, probably would be wise to make note of that and at least alert management before those variances are realized, so that nobody's surprised in the end and looking to point fingers, because depending on where you work, the circle of blame can be a very wide one. Now, we will also have non-manufacturing activities that we can contribute to that, administrative, selling activities, all of those things. If we're probably not going to use those for things that are unique because it's more difficult to predict things when people are doing non-routine tasks. We now have factory overhead variances, and depending on whether or not we have a variance, it may or may not be controllable, I guess I should say, in terms of the end result, because folks may be doing the best they can to control costs, but there may be things that happen that are beyond their reach that they can't affect any change on. To calculate this, we're looking at the actual variable overhead minus the budgeted variable overhead, and then that tells us theoretically what the variable overhead of controllable variance is, but again, the extent to which that was in fact truly controllable is something that needs to be investigated, and not just assumed that because we call it controllable that it in fact was controllable. We will also have a variance for our fixed factory overhead volume, well, or probably, quite likely. And so we're going to compute the variance based on volume. And this is assuming 100% of a normal capacity, not an ideal capacity, a normal capacity. So make sure that whoever's doing those computations is pulling the correct number and not comparing our normal operations to the pie in the sky numbers. Sorry, I keep moving myself around here, but these slides are really full. So again, we've got favorable and unfavorable variances that may occur. And so what contributes to an unfavorable volume variance? There may be uneven workflow. So there may be points at which you've got a bottleneck in your system and you've got other people that are just sitting around waiting for work to come down the line. You could have a machine breakdown that could also cause a bottleneck or a stoppage. Stoppages caused by problems with you don't have the raw materials, or there's not enough work to keep the factory operating at normal capacity. So you've got people now cleaning when they could be producing widgets, and maybe they don't want to lay them off or send them home. We're going to have a factory overhead cost variance report, and we're obviously with factory overhead, we are going to have, we've made this assumption based on what we believe our factory overhead is going to be, and then we've applied that to our product, or we've used direct labor hours, or whatever our driver is. And so if in fact we have not done that correctly, one way or the other, we're either going to have under-applied overhead or over-applied overhead. So if we have under-applied overhead, we've basically failed to adequately estimate the amount of overhead that should be applied, and that's a debit because that represents increasing costs. The over-applied, you can look at that almost like a favorable variance when we were looking at the other items, which is that we've done better than we should have, and that our costs are less than what we've actually applied. And so the difference between these two in terms of the overhead and cost variance gets us a total either favorable or unfavorable between the two. And the variable factory overhead controllable variance is computed by comparing the budgeted with the actual. So management is going to want to obviously track these variances, and so they may have journal entries that are made to these budgeted items alongside the actual items, not for reporting to external users, but that will help us come out with where we were at overall in the end. And so, and I'll explain that more in a second, but we've got our work in process, wages payable, direct labor rate variance, all of those things. We can have journal entries made to our standard budgeting accounts. Same thing with overhead. And at the end of the period, we get this overall either net favorable or net unfavorable result, and we can use that to do sort of a management income statement that we can then compare to the budgeted income statement we had done at the beginning of the period, which had our projections in it, and then it becomes sort of a complete picture of how the company performed. We're not going to be using these variances externally. These are just tools for our management to use, and when we're preparing the actual income statement, any variances are going to get folded into cost of goods sold and not going to be broken out separately. So I think we talked about situations in which we might have non-manufacturing labor-related costs, and we still can use it. There are still scenarios in which we should know how long it takes someone to do something. So how long should it take a bank teller to process a customer deposit or a customer transaction or things like that? If you look at, if you've ever worked in a fast food restaurant, when I was in high school and I worked at McDonald's and I operated the drive-through, there was a certain time that was the standard time that I had in order to, from the time a car pulled up to the window, to take the money and make sure that their order was together, get them their order, and pull away. And there were times in which the managers would actually come in and time me as part of a performance evaluation to ensure that I met the standard time. So there are ways to use this when it comes to non-manufacturing tasks as well. And then these are the revenue variance items, which I'm not going to go into. They're in the appendix in your book if you want to dive more into this because you have a burning desire to know more about variances. Well, the appendix is where you'll find that, but it's not anything you will be tested on. And that concludes Chapter 9.